Good afternoon and welcome to our very first Market Insights webinar for 2025. We have a jam-packed session today, but I wanted to take the time to start with an acknowledgement of country and to also take a moment to send well wishes to any brokers and also our amazing BDMs in Queensland tuning in. You may have been impacted by the actual cyclone last week, so I hope everyone's okay up there in southeast Queensland and northern New South Wales. To kick off with the acknowledgement of country, AMP acknowledges all First Nations people across Australia. We recognise the traditional custodians of the land and value the connection to country, waterways and sky. We pay our respects to the elders for their resilience, courage and wisdom for ensuring the survival of this country's rich culture and heritage. First of all, thank you very much for everyone for joining our webinar today. We're thrilled to have you on board. And if anyone has actually submitted questions as part of their registration, and for all of you that have done that, with any burning questions you may have for our speakers, can you please look at the question tab on the right-hand side of your screen, and please feel free to use this throughout the session. I'll put further reminders during the session and actually get you to put those questions into the tab, and then I'll be able to ask those relevant parties during the webinar those particular questions and answer any burning questions you may have. So what's on the webinar for today? We have Paul Herbert, Head of Lending and Everyday Banking Distribution, and he's going to provide us a strategy update accompanied by one of our senior BDMs, Dave Askew. We also have Melissa Christy, a Head of Lending Origination, AMP Bank's new broker platform, some amazing upcoming news starting midway through the year. And Diana Mousina, our Deputy Chief Economist, and she's going to provide the view from our economics team, the impacts of rate cuts on the marketplace. We're then going to follow that up with a Q&A with the panellists that you have here today. And so we're going to kick on and kickstart the session for you now. So Paul, great to have you on board. Thanks for joining us today.
Thanks, Trav.
AMP Bank is obviously, its mission is to be the best digital bank. And can you please maybe give the audience and take a moment and explain what that means specifically in the third-party broker space? That'd be amazing.
Yeah, thanks, Trav. And can I say, well done on leading your first webinar. It's great to be able to hand this over to you. Our vision is to be the best digital bank in Australia. And to do that, we need to take a number of, I think first and foremost, as a bank with no branches and traditionally very strongly led by support from our brokers, we need to make sure we take the right steps to appropriately support both our customers and brokers on this further journey. So there's a couple of things we're doing to support that. So first and foremost is a really simple to use and really clean and easy digital banking app available for small business and personal customers. Now, this is something we've only just started releasing to the market now. It is a really significant step change on the existing app platform that we use. What it does, it's really tailored about supporting micro, SME and SME businesses. So for the likes of our brokers, these are the type of bank facilities that our brokers may be wanting to use, not only for themselves, but also for their customers. We've also taken steps to reimagine, which Melissa's going to touch on in far more detail, reimagine what the mortgage origination process can look like. So for many years, we've heard about the difficulties and duplication of effort and work to get applications through for customers in a timely manner. We think we've found a way forward, or we know we've found a way forward to really streamline and improve that experience for our brokers. And most importantly, all this matters in an environment where there's a high degree of support. So we can't just have digital tools for the sake of digital tools and great digital processes for the sake of digital processes. We have to have great experience and service supporting that as well. So we've doubled our efforts in improving and lifting and continuing to lift the broker experience we deliver, not only through our awesome BDMs, but also our broker experience team, our credit analysts, our settlements team, and all the way through also the retention team journey of our existing customers as well. So it's a real package that we're undertaking to deliver a really world-class and best-in-market experience for our brokers and their customers.
Sounds like there's a bit on with the teams.
There's a bit on. There's a bit on.
Thank you for that. That's great insight, Paul. How do you see the integration of advanced technology influencing AMP Bank's ability to innovate and differentiate its products in the marketplace moving forward?
I think, Trav, there's a couple of things here. One's about simplification. We have to get away from complex ways of doing things. We have to get away from complex policies. We have to start looking at really simplifying our offering and market so our brokers can readily understand where we sit and, most importantly, how we can solve problems for their customers. So we've taken some steps over the course of the last sort of 6 to 12 months to really purposely lean into simplifying the process. And if you think about what we did around recent credit policy changes, and I think Dave might talk a little bit about that later, so I won't go into the detail, but that's where broker-led feedback has been really, really important about how do we streamline the way we deliver services and also experiences to our customers. It also simplifies it for our credit analysts as well, because they're dealing with our brokers every day, and it means there's a closer alignment between what we're intending and what our brokers are delivering for us. And that then helps us to build scale and stability. It helps us also to break the dichotomy between more volume requiring more people. It allows us to then deliver a more consistent service experience for the customers through the origination process and beyond.
There's so much going on. What's most exciting you about what's going on at AMP Bank this year and beyond?
There's a lot, isn't there? I guess I'd be lying if I didn't say it's what we're doing through our re-origination process as being the thing I'm most excited about. This concept Melissa brought to the business a couple of years ago, to see where we are now, where we're piloting loans going through and a completely new re-origination process. It's been reimagined the entire journey through. And to see the brokers who have been with us since day one as we've built this journey go from, I'm not sure how this is going to work, to, oh my goodness, this changes the game, talking to our aggregators and listening to the way they have now understood what we're trying to achieve, because it's so different to what they've always done and what they've always seen. It's taken a while for people to realise what we're doing, but now there's a realisation coming. I think our brokers will be really excited. It'll be a change. It'll be something different. And with change, comes a lot of energy and effort to maybe adopt different ways of doing things. But without doubt, that's probably the most exciting thing. Beyond that, I think what we're doing through our small business and personal banking division, really supporting micro, SME and SME businesses. And again, our self-employed policy alludes to that. Again, it leans neatly to our broker market. What we're doing through business finance as well, helping brokers and financial planners to build and grow their business. What we're doing, we're really backing in behind the broker channel. So I think they're the things I'm most excited about. And I think we've also reduced our fixed interest rate to effective yesterday. Yeah, effective. This is the one, yeah, which you so happen to have a slide on. So, and again, we're trying and doing different things, and I think that's one of the benefits of being with a small bank and working in a small bank, and for brokers to work small allows us to be a bit flexible and nimble, and move close to what our customers need more rapidly.
Yeah. It certainly was well received. We had a PD day last week, and it was certainly well received in regards to the new digital platform and how excited the audience was, and we're looking forward to it. So we're looking forward to sharing more with Melissa this afternoon.
Fabulous.
Thanks very much. Thanks, Paul. Appreciate that. So, David, over to yourself, mate, in regards to there's obviously some really exciting things happening within our AMP Bank at the moment. Well, if you don't mind, if I could get you to share some of the niches with where AMP is playing in right now to the audience, that'd be fantastic, and how we actually can support our brokers and customers through the journey.
Absolutely. Thank you so much. Great to be here on the webinar. There's probably hopefully a couple of thousand brokers online, so we certainly appreciate your support. I'm a senior BDM and I've been with AMP for quite a long time, only 27 years, so there's a little bit of knowledge and fun. It's a great place to work, and I think in our team, led by Travis, the gentleman to my left, we have a real passion and energy to sort of see as many brokers as we can. So I think in terms of niches, for us at the bank, excitingly for us in 2025 particularly, is to really get to see as many as you as we can. We have a fantastic support set up now with our broker experience, where they're managing and they're in our inboxes. So there's no excuse for us not to be in your face, having a meeting with you to discuss what we have. I suppose just briefly, a key thing that I discuss with a lot of my brokers is a dynamic feature that we have called Master Limit. So our Master Limit feature, that is a great conversation point for advisors, for brokers with their customers. It's an overarching umbrella limit that we'll approve up front for 5 or 10 years. And that gives customer and the advisor the stability to know that you've got that limit. So, for example, you could have a $200,000 owner-occ limit and a $500,000 investment limit. And quite often, strategy-wise, we see a lot of brokers and advisors doing debt recycling. So that feature that no other bank has, mind you, is actually key to delivering a great experience for your customers. So certainly speak to your BDMs, whether they're desk-based, road-based, about that. Recent changes from last year in July, our self-employed policy, that's seen a great amount of business flow through to us, which we appreciate. It's 1 year tax return, and we can still accept 2023 up until the 31st of March this year. So it's just the one return, no profit and loss, no financials, and the NOA. So that's there's some great information on our website and distributor centre, and you'll see our communications we send out weekly. There's a lot of updates in terms of that. Other things that are hitting the mark for us, Travis, is the CDR. So our common debt reducer policy, which is where we enable you have a loan with your sister, you've got a debt, rent, expenses. So we can apportion that in the servicing based on what the title share is. So that does help you if you're then buying a property with your partner to have more serviceability. Things like our bonus policy that was updated. And I know we've probably talked about this a lot, but 80% upfront for $100,000 bonus for any, I'm not saying executive or anyone professional to get that kind of bonus. So they're the kind of customers that we're sort of looking at getting. So in terms of the entire team around Australia, we're all a very well-knit team. If you can't contact one of us, just go to the list on the distributor centre and call all of us, and we're all happy to help. So that's some of the things that we're looking forward to in 2025.
What about the dealing with the credit team too, David, in regards
actually, I should say that's one of the most important things. So thanks for the reminder. We have an amazing HDLA, a Higher Delegation Lending Authority team at the bank. They're a team of 4 or 5. They're superstars. So if you have anything that's potentially difficult or you want to run by the BDM initially, come to us with that scenario rather than have to, submit and get declined. Have that pre-discussion, of which we can get the tick from them to potentially say we'll either provide an exception or move forward with them. So that is a fantastic part of our business. And I know a lot of brokers do value that, as we do as BDMs.
So some great ways of doing business differently, and that leads on to saying you can bank on us at AMP. So great, thank you very much, David, for the insights in regards to what our niche credit policies are. If you'd like to find out more, please reach out to your business development manager, and they'll be more than happy to run any scenarios past. Don't forget that if you've got any burning questions for today's webinar, please drop them into the Q&A panel. And at the end of the session, we'll get back and answer those for you as well, or we'll get one of our team to respond to you privately if that is also the right response. So thanks very much. Now, what I'm going to do is hand over to our Head of Lending Operations Manager, Melissa Christy, who's going to run through our new digital broker platform. Melissa, really exciting. Paul's already touched on it, but some really exciting news coming up this year. As we said, we launched it at a PD day last week. Really, really well received. I'm not going to steal any of your thunder. I'm going to hand the clicker over to yourself and get you to give the brokers an update with what's coming and ahead for AMP Bank.
Thank you, Trav. Hi, everybody. I'm Melissa Christy, and as Trav said, I'm Head of Lending Origination. What does that mean? That means that I'm responsible for everything in the origination process from when you're submitting an application right through to settlement. So I manage the credit team, that higher delegation team that we just spoke about, and the settlements team. But it's also why I'm deeply passionate and responsible for the transformation of that whole experience that you have with AMP Bank today. So, you've heard that we have a new AMP Bank broker platform coming, and we do think it's a platform you'll want to shout about, so let me tell you a bit more about it. So why is the transformation of the broker platform really important to us? It's important to us because 95% of all our home loans are introduced by you to us as brokers. So it's very important to us that we provide you a platform where you have a great customer experience and we can provide you a consistent experience and also a faster time to a decision. So I'm going to take you through a bit more. So we know what some of the challenges are today, and these are challenges with both us but also other lenders in the market. We know that there is a lack of transparency out there. We know when you push that button to submit to AMP Bank, you don't know what you're getting. You could get a really good experience or you could get a not so good experience. And we want to change that in how we go forward. We know that there's a lot of duplication of effort across the board today. You do something up front as part of your process, and then we ask you or your customer to do it again when it comes into us. So, of course, we want to remove that. Today, there are a lot of requests for more information. We know that you submit a deal, you think you've provided everything, and we come back and ask more questions. So we want to improve that. And we know that our time to decision can sometimes be variable. And we know it's longer than we expect. And we know simple things today that we do aren't good enough. For instance, we know today that we let you know that a deal is unconditionally approved, but then the email that you can give to your customer takes a long time to come out. That is just a very small example of things that we will fix in our new platform, where we'll be streamlining and automating the process so we can get things to you quicker. So, what is this AMP Bank broker platform? Well, basically what we're doing is everything we have today from a lodgement perspective, from an assessment platform perspective, as well as our panel solicitor, it's all changing. Everything we have today will be gone, and we will be basically starting from scratch with a whole new experience and new platforms. So that means we will be accepting deals through LoanApp. LoanApp will be the only lodgement platform that we will use once this is all live. There will be a small cutover where both platforms will be available, but the long-term goal is that LoanApp will be the platform where you will lodge us. Our My Assessment team will also use our Sympology platform to assess the deals, and our unconditional approval process from loan docs to settlement will be managed by MSA National. We've also partnered with other leading tech providers to build this new platform so we can provide you a more automated solution, and we can verify a lot of the data you provide us up front. So I'll take you through more about that shortly. So overall, the whole end-to-end mortgage origination platform will change. And I'm now going to show you a reel, which will actually take you through some of the benefits, and then I'll go through that in detail afterwards. Okay, so that gave you a bit of an overview of the platform, but I'm going to take you through the benefits that we had in that reel in more detail. So what are the benefits for a broker? Ultimately, what we're doing is trying to give you a faster time to a decision, but also provide a more consistent experience when you choose AMP Bank. So first one, income and expenses verified up front. What does that actually mean? That means that we have integrated with a number of services in our platform so we can verify the income upfront, your customer's income upfront. We are not forcing you to use a particular solution. We are not forcing you to use screen scraping or open banking. We have a number of services that can be used to provide you a digital verified income on screen. It will appear next to your declared income. So you'll see declared and you'll see digital side by side, and therefore you'll be able to compare the two and run serviceability on both digital and declared, and choose if you want to submit on digital or declared. What we ask, though, is if you submit on what you've declared, is you explain why you've chosen to submit on declared rather than the digital that we've presented. And that means we can look at the application when it comes in, but we instantly know why you've chosen to submit on declared. So you can explain up front, means we don't have to come back and ask. We also can verify expenses up front. What does that mean? That actually means we're verifying your declared expenses that you submit. Even though we might collect digital expenses, or we may not, we won't be running our rules on digital expenses because we know that digital expenses are often categorised incorrectly or also include a lot of things a customer has done, like car repairs or a trip overseas or a kitchen renovation, things that aren't normally part of their everyday expenses. That's why we expect you've been through expenses up front and that you'll be using, that you've already narrowed down what those declared expenses are, and we will run our rules over those expenses and we'll let you know if we find something that doesn't make sense. And that's all pre-submission. Rules are run up front. As I said, rules will be run on a whole range of things, income, expenses, but also policy rules and decisioning rules will be run up front. And those will be presented to you if something doesn't look right. Some you won't be able to bypass and some you will. And if you do choose to bypass a rule, then we'll ask you to explain why so we don't have to come back and ask you why. And all of this is built into the platform. You'll be able to reuse the VOI you've completed before submission. We know many people in the market already use IDverse, which used to be known as OCR Labs, upfront to do a VOI process on their customer. Today, you can, when you choose to apply with a particular lender, often they ask you to go down the road of their particular provider for VOI or ID, and then your customer has to do it over again. So what we've built here is that if you've done it up front and you want us to reuse it so the customer doesn't have to do it again, then you can assign that to AMP and therefore we can then consume it. It saves on that duplication for your customer. So with all these rules running up front and showing you digital expense, running rules on expenses as well as all the other rules, it will mean less rework after submission because we're asking you if something doesn't look quite right or something doesn't meet all our requirements, we will ask you to explain or provide a supporting doc if required before submission. All of this is to improve the time that we can get you a decision. And from a document perspective, we are moving to issue documents really quickly. 90 seconds is, and obviously today it's more like 24 to 48 hours where you're getting docs. So this is an amazing improvement we'll be able to provide. Also moving to MSA National, the difference here is that they manage every application. There is a case file owner for every application and you will know who that person is. So if you have an issue, you'll be able to pick up the phone or email that particular person who knows about your application. We've also overhauled all our documents to make sure that they're actually more customer friendly and they look a lot better than they do today. So all of this is to pull your customer off the market quicker and you get that approval much quicker. So you've asked, we've listened, we built, and to be honest, we're actually still building, but we are almost there. We're piloting with brokers from April this year, and we're launching full to market for all brokers in Q3 2025, and we're really excited about bringing this to you to market. I'm now going to hand you over to Diana Mousina, who is our Deputy Chief Economist here at AMP, and she'll be taking you through some recent upcoming market movements and how that might impact you and your customers. Thank you.
As we do the handover, as mentioned, if you've got any questions, please feel free to put them in the tab on the right-hand side, and we'd love to answer those questions for you at the end. Over to you, Diana.
Okay, thank you so much, everyone. It's a pleasure to be here today. So before we get started, if you've watched some of our webinars before, some of our presentations, you know that we always have to show you our disclaimer. This is not personal financial advice. This is general advice. If you need personal advice, please go and see your financial planner. So the biggest change that we've seen in the last few months that's going to impact on the housing market is, of course, the first rate cut from the Reserve Bank of Australia. It was very exciting, but basically completely predicted at the February meeting. The Reserve Bank cut the cash rate from 4.35 to 4.1%. So a 0.25% interest rate cut, about 90% predicted by financial markets. The Reserve Bank is a bit lagged on the journey to cutting interest rates. You can see in the chart here that most other global central banks have already been undertaking the process of cutting rates since around the middle of last year. Places like the Bank of Canada has already cut by 2%. In the US, the Federal Reserve has cut by about 1%. So we are a bit delayed to this process, and the biggest reason has been basically because our economy has held up and because underlying or what we call trimmed mean or core inflation has held up a bit higher compared to some of our global peers. The outlook for interest rates from here is basically for another 3 rate cuts, or 2 or 3 rate cuts this year, I should say, from the Reserve Bank. So we at AMP think that we will have at least another 2 rate cuts, but I wouldn't rule out more than that, with the next one coming in May and then in August. A lot of people said that the decision to cut rates was political in February because it was happening before the election. And we know that the cost of living challenge is really the biggest concern heading into the election this year. Most incumbent governments in the past year across the Western world who have gone to election have not been re-elected or lost their majority because of the issues of the cost of living challenge. So high inflation and real wages growth not keeping up with inflation. The decision, though, to cut interest rates was absolutely not political. If you look at this chart here, this is core inflation around the world. And one of the biggest arguments for why the Reserve Bank shouldn't have been cutting rates last year was that there was no need to, because our core rates of inflation were still holding up at quite a high level. But as you can see here, basically, core inflation is now running at the same level in Australia as it is in every other major country. And the reason that it was, I guess, holding up a bit higher last year was really down to services. So we did have quite sticky services inflation in things like rents, new dwelling construction costs, wages growth also had a bit of a delayed rise in Australia. We have a lot of inertia in our wage setting system. So a lot of wages here are set, 60% of our wages actually are set by awards or enterprise bargaining agreements or minimum wage decisions. So they're all tied to those outcomes. And that increase about nearly 2 years ago actually has had quite a long lagged impact into the market. So when the Reserve Bank saw the data in January, that core inflation had fallen lower than where they were expecting. So it's now running below 3% on an annual basis. We think that by the middle of this year, it will be at about 2.7%, and that headline inflation will be at a similar level. There was no reason really not to start the process of reducing interest rates, because if we didn't see those rate reductions, there is the risk that we would continue on this quite sluggish path of growth that we've been on, and also risk to a lift in the unemployment rate. Our unemployment rate here has remained quite low, and surprisingly so. So the unemployment rate here bottomed at 3.5%, and it's only risen to about 4.1% on the latest numbers. In a lot of other countries like the US, actually, they've seen quite similar outcomes, that the unemployment rate hasn't risen too much. Whereas in other countries like New Zealand and Canada, we've seen a bit of a softer labour market and a bit more of an increase to the unemployment rate. But the problem with keeping rates high is that you don't want the unemployment rate to keep going up. That would really reverse some of the positive gains that we've made in the last 2 years in terms of keeping jobs growth very strong at a time when interest rates were still being increased. So the Reserve Bank has actually been one of the only major central banks to outright say that they are trying to preserve the gains in the labour market. They don't want to slow the economy too much by keeping the cash rate elevated. They also want to look after jobs growth, which is why they never raised rates as much as some of the other countries. And also because there was no real need to, because of the way that our economy responded to those higher rates. I also wanted to, just actually before I get to the next slide, I also just wanted to touch on what the outlook is for the labour market. I think that will determine what the RBA does from here. Basically, our view on inflation is that, as I said, inflation is going to keep slowing in the next 12 months, so to about the midpoint of the target band. which will justify the need for some of those further rate cuts. But don't expect too many rate cuts because, well, one, the unemployment rate is not surging from here. So we don't expect the unemployment rate to get to 5% or above where it was before the pandemic. We're now seeing that wages growth is softening. So we can sort of stay in this environment where the unemployment rate is likely to hover between 4 to 4.3%, which is a very good outcome for Australia. I would expect another 2 or 3 rate cuts from here, but don't expect the cash rate to get to 2.5% or below. We sort of expect it to bottom at about 3.35%, maybe 3.1% in late 2026. Of course, tariffs are on everyone's mind at the moment, and the US share market has fallen from its highs. And there is a lot of concern now that the US economy may be headed into a bit of a downturn, and it's all because of the result of tariffs. I mean, if you ask any economist, 99% of economists will tell you that tariffs are negative for global growth, global trade. And I think this cartoon sort of summarizes how a lot of economists would think about tariffs, that it would just come back to bite you in the end because they raise prices for consumers, and that tends to be negative for growth. So there are a few things to keep in mind in terms of tariffs. One, we don't actually know to what extent tariffs in the US are going to increase or around the world. It's still a bit of an unknown because basically the Trump administration does keep on changing its mind a little bit about how they're going to implement these tariffs and to what level. They are being used as a negotiating tool. If you see the rhetoric that comes out from the administration, they're trying to achieve something by implementing these tariffs. They don't actually just want tariff rates to go up. They want an outcome from them. So they either want to stop the drug flows that are coming in, that they say from Canada, Mexico, and China, or they want stronger border controls, and they're using tariffs as a tool to get what they want from that, which is why they keep on going back and forth on them. First, they implement them. Then they say some of these goods are going to be excluded from tariffs. And then they say, actually, these tariffs are going to start from the 2nd of April. So it is a little bit overwhelming, especially as someone who has to analyze all of this data every single day. What I think is most important to keep in mind is that US tariffs rates are going to go up around the world. It is going to have some negative impact to global growth and global trade. The US economy is likely to slow as a result, and some countries are going to be impacted more than others. For Australia, the impact to us from tariffs is going to be quite small. We export only about 4 to 5% of our exports to the US economy. This is a chart of US total imports, and you can see that Australia is just a sliver of all the other imports that it has. 60% of US imports come from Canada, Mexico, China, the European Union. So these are the countries that are going to be most impacted by these tariffs. The tariffs on China have already started. Some on Canada and Mexico have already started as well. The others are going to start on the 2nd of April. So I think the US share market has some more downside from here, not just because of what's going on with tariffs. That's only one part of the new policy, of the new administration's policies that they're coming out with. So there's other major things happening around fiscal policy, immigration, and then, of course, taxation and more around the budget measures. So the changes to fiscal policy in terms of reducing the size of the public sector, some of those public sector job cuts that are happening as a result of DOGE, will work to slow down fiscal policy. And fiscal policy growth has been a major reason why the US economy has been strong in the last 2 years. So, and then there's also the impact to business confidence from the uncertainty around tariffs, around the potential for fiscal policy changes, and the new administration changing some regulatory things as well. So it's not just the slowing in the US economy that's likely to happen in the next 12 months is not just a result from tariffs, I want to point out. It's from a result of some of the other policy changes that are going on. On the plus side, the Trump administration is talking about implementing lower taxes for the US. The House of Representatives has already passed part of that package, but it has to be passed through the Senate as well. So lower taxes is a boost to US economic growth, both corporate and individual taxes. And they're also talking about some deregulation across some of the sectors, which in Trump 1.0 was positive. So all up, I think the US economy is in for a bit of a softer year this year because while I think tariffs are going to be used as a negotiating tactic, it might take some time for that to play out. And in the meantime, I think some of the data is going to slow from the impacts of uncertainty and also as a result of tariffs going up and some of those cuts to the public sector and in just terms of lower fiscal stimulus. And those tax cuts will also take some time to actually get implemented. So maybe a bit of a softer year for the US economy this year, and I think that will be reflected in US share markets as well. The US has been a massive outperformer in the last few years, both in terms of shares and stocks. It's very likely that we could see a 15% drawdown to the US share market this year, peak to trough. In Trump 1.0, the US share market fell by 20% peak to trough. But overall, we still expect that by the end of the year, we will have positive returns from shares. But in the interim, I think investors can still get worried. The risk of a recession, I'd say, in the US is probably about 30 or 40% in the next 12 months. While the administration would want to avoid a recession outright, sometimes things just get put in train that where it might just be too late for them to sort of prevent any outright recession from happening. So I guess I'm not too pessimistic, but I'm not too optimistic on the US economy for the next 12 months either. I think that some of these policies will have a negative impact to US growth and to US share market performance. Coming back to more of what's happening locally and just specifically on the housing market, which you will have obviously a lot of interest in, we've seen already some impacts from the first RBA rate cut on the housing market. So the CoreLogic price data for February showed a bit of a tick up across the capital cities. Prices increased, and in particular, prices were increasing in the more rate-sensitive parts of the market, which look to be Hobart and Melbourne at the moment. So we know that Melbourne has fallen by about 7% from its peaks, maybe about 8%. But I think that weakness has now basically passed through because it responded quite positively to that first rate cut, and Hobart too, which were the two main negative performers of the last 12 months. Melbourne, I think, is down to some of the reasons around too many, they're basically that they've been oversupply across the state, maybe not so much in Melbourne in particular, but Victoria has had a bit of an oversupply relative to some of the other capital cities for housing. And Hobart had a very strong performance over the pandemic, and now some of that is washing through. So I think the chart on the top there really tells the story quite nicely about what's been going on. Basically, you've seen this massive outperformance in Brisbane, Adelaide, Hobart and Canberra, which is that green line across from the last 2 years. Now, all of that is down to affordability measures, the need for more space, migration flows, particularly into Queensland and into South Australia, from, again, affordability and also, I guess, a post-pandemic realisation of where people want to live and work. Sorry, excuse me. And now, and Sydney and Melbourne have not been underperformers, but Sydney's sort of been around the middle of the pack. Melbourne has been underperformer, and Perth and Darwin were playing catch up quite a lot as well. Perth has actually been a very strong performer in the last 12 months. So with the rate cuts that are coming through, we think that Hobart and Melbourne are going to continue on this upward path, that they've been underperformers and they're likely to get some more traction. Affordability metrics look very positive in Melbourne. It's now more affordable than most of the other capital cities around the world, even more affordable than Canberra and Adelaide, which has never happened before. And I think that the outperformance from Brisbane and Adelaide is going to soften. Perth might have a little bit more upside because it did go through basically a decade where it did nothing after the mining boom collapsed. So Perth probably has a continued more upside from here. But we can see the positive impacts on the housing market in auction clearance rates and the CoreLogic price data. So the housing market is still sensitive to what happens to Reserve Bank interest rate changes. That's important to keep in mind. Our view for this year has been that we'll see property price growth of about 3 to 5% nationally. Of course, as I just said, there are going to be differences across the capital cities. So that's just a national average performance. We think that we'll get about 3 to 5% growth, not as high as in some cutting cycles, but there are reasons for that. A major one is basically that capacity to pay and the affordability challenge is still very much there. So just because we've had one rate cut doesn't mean that affordability is going to suddenly get so much better. The average borrower can probably borrow an extra $6,000 to $7,000 just from that one rate cut. So say we get 3 rate cuts, the average borrower can borrow probably another $20,000 to $25,000. I mean, that's not going to make, if you're already looking to get into the market, it's not really going to make too much of a of a difference to that decision. I think it will push some more people into the market. Thank you so much. I think it will push some more people into the market, but it's not going to reverse some of the very strong home price growth that we've had now for decades in Australia. And the chart on the bottom really describes this. So this chart looks at the average ratio of home prices to wages in Australia. Back in around the 1950s, 1960s, the average price of a home was about 5 to 6 times your average wage. Now it has risen to about 14 times your average wage. So these decades of very high home price growth are incredibly difficult to replicate. And we had periods of, we had basically a decade of very low interest rates in the period prior to the pandemic, which did sort of which propelled this ratio to a much higher level. So from here, affordability is still a big problem in Australia, and the housing and the government has actually made quite a lot of changes to housing policy in the last 12 months. I will give the government a lot of credit for that. Probably the most changes that we've had to housing in a long time, but it's very difficult to just reverse all these years of very strong home price growth. And to be realistic, it's not going to get reversed. From here, what is needed to get affordability more on track is basically to keep the ratio of home prices running at the same level of wages. So to prevent home price growth from accelerating above wages, we just need the two to grow at the same. I think that some of the changes that the government's making to housing will help around this. Housing, I think, will become more of a topic in the next few weeks as we go into the election cycle. It's basically been confirmed, not confirmed, but most political commentators are saying that the election will be held in May now rather than April. So we will see some more policies coming out from both sides. I've just written a few here from both sides of government. The Albanese government has put in a lot of investment into housing investment, trying to get more supply onto the market, because basically that's the only thing that we can actually do to help affordability is to supply more and to align our supply to our demand targets. And demand comes from basically migration. So we do need to align our migration and supply targets better. The coalition is talking about taking money out of your super so the policy is called super for housing. I think we're going to see some more information around that. But besides that, they haven't really spoken too much about other policies. I expect to see more investment into actual supply from the Albanese government. It would be good to see some of the regulation around housing in terms of the construction process and the approval process, some of that get reversed as well, because that is one of the biggest things that is preventing construction from occurring at a faster pace in Australia. And we just really need to get construction moving again. I'd expect to see some more cost of living rebates from the Albanese government, and the budget, which is now confirmed to come out on the 25th of March, is likely to contain more of that cost of living relief. It is going to be a pre-election budget. It's going to have some goodies in it for everyone, not going to have any really specific items that are going to help Australia's lacking productivity challenge, which is something that is going to become more of a problem in the next few years, but it's obviously hard to do because reform doesn't win you elections. But I know that's probably a topic that needs more discussion and more time, which unfortunately we don't have today. We do have some time in questions, so feel free to ask me a question in the Q&A. You can also follow Econosites and our team for some of the videos and updates that we do here as well. Thank you.
What an amazing update, economic update. Thank you so much, Diana. That's fantastic. And if you haven't jumped onto the social medias, I just might go back a slide there and go back and just share that again one more time for the Econosites, and making sure Instagram and TikTok for Diana. I follow it myself personally, and they're absolutely gold. So well done on doing those updates to the market. We've got a couple of questions, Diana, that's come through from the audience. So if you've got any questions, please feel free to put them into the question on the right-hand tab. That would be amazing. But there's a few questions we've received. First one is a prediction on inflation for the next few years and where you see that's heading for Australian economy.
Sure. So in the next 12 to 18 months, I'd say inflation is likely to average at the upper end of the RBA's target band. So they target 2 to 3% inflation. and we think it will average somewhere between 2.5% to 3%. So don't expect inflation to get back to its pre-pandemic levels of 2%, if not even below that. And then if we look and a lot of that I think will be driven by still elevated services inflation. So services makes up about 70% of what individuals spend their money on, really. And wages growth is still, it's slowing, but it's still higher than where it was before the pandemic. Rental growth is still elevated. All the personal care services prices are still more elevated than usual. Goods inflation hasn't softened as much as it has in a lot of other parts of the world. In places like the US, they actually had goods deflation. So goods prices were running in negative terms, whereas here we have had a big slowing in goods prices, but you can still see pockets where prices come up, like eggs, for example. Everyone's talking about egg prices. I mean, they were already elevated six months ago, but because of the bird flu issues, they still continue to be rising. So a lot of the food prices in Australia have still been elevated in the last 12 months. But then if you think about, outside of the next 1 to 2 years, in the next 5 years, there are still reasons to expect inflation to probably be a bit higher compared to the decade before the pandemic. So if we think about what's going on in the budgets at the moment and the government sector, the government in Australia has now risen to a record share of the economy. That tends to be inflationary. Budget deficit projections in the out years are still looking very elevated. That is going to be inflationary. We have a decline in the working age population relative to our older population because our population is aging. That means that savings are going to be drawn down. That tends to be inflationary as well. We're moving into a less globalized world, as we can see with some of these tariffs and the disruption to free trade blocs. That is going to be inflationary from impacts of tariffs. The only thing that I can think of that may reverse some of those issues is around the adoption of AI and the productivity gains that we get from that. That could be less inflationary, even deflationary in parts of the world, but I think it's too early to see those inflationary impacts come through. I think the productivity impacts of that are going to start being more apparent. But in terms of inflation, I'm still not convinced that that's actually going to be deflationary for us. We just need to wait and see if that actually impacts on the productivity numbers, which are very poor in Australia.
So you've spoken about property prices and with what you're expecting that to do, but we're looking at another 1, 2 possible rate cuts, as you mentioned.
Yeah.
I've had a question specifically around the Melbourne property market. Do you think that that'll start catching up with the other states, Melbourne, in regards to if we have another 1, 2 rate cuts?
Melbourne and Hobart seem to be the most sensitive at the moment. I mean, they have been the underperformers in the last 12 months. So they responded the strongest in a positive sense to the rate cut. So I think that the better affordability outlook for Melbourne and coupled with the rate cuts is going to be positive for the capital city. I mean, Melbourne still has very strong population flows coming into it, and a lot of that interstate migration outflow that was happening into Victoria, I think, is not going to be as strong as it was in those first few years after the pandemic. So I think that Melbourne has a positive year ahead of it.
And do you think, a lot of people ask also in regards to the time frame it takes for the family to really feel the rate cut?
Yeah.
Like, I know we've just had the first rate cut. How long do you anticipate before they really start feeling that in their hip pocket? The second, the third, or beyond that? And when do they expect to see that making a difference to their family?
Yeah. So the average household with a mortgage has about a $600,000 mortgage, if you believe the official stats. But this is total household. Some people might have $50,000. Other people might have $1.5 million. I mean, we're just talking about the average consumer, average household in Australia. So I know that there are it's a very big spread of people. But on a $600,000 mortgage, you're looking at a saving right now of about $100 a month from one interest rate cut. So we're not talking too much, sandwich and a coffee a week type of thing.
Yeah.
It takes about 3 months usually for actually the bank to pass on those changes. If you're on a variable rate, of course, if you're on a fixed rate, that you're not going to be impacted. If you're on a variable rate, usually about 3 months. So there's actually the direct impact, but then there's an indirect psychological impact. I think that people have, that the rate cuts are coming, things are not going to be as hard, and I think it's a bit of there's other positive things going on. So we've had we've had one rate cut, likely to get more. We've had tax cuts from the 1st of July of last year. And of course, inflation's come down too. And actually, inflation has been the biggest negative weight on households. It affects everyone, and it has been very elevated. So if you add up all of those things on our calculations, the average household is better off by about $80 a week or so. So that's pretty good if you take into account rate cuts, tax cuts, and inflation now. So $80 a week better off now compared to a year ago. So rate cuts actually not the major thing that's contributing to that more positive cost of living environment for households. But I think a lot of people say, well, you economists just talk about inflation. It's come down from 8% now to 2.5%. Well, that's great, but the level of price is still very high, and absolutely it is. So there is a difference between rates and inflation, which is really important. Rates and level, which is important to keep in mind. So the level of prices that you're paying for things is not going to go down unless we have outright deflation, but we're not going to get that. So expect that still the prices of your grocery bill is going to remain high now forever, basically. It's not going to be growing at the same rate that it was. Obviously saw a big level shift from your grocery bill right now compared to where it was before the pandemic. And we've seen a 20% increase to inflation over a 4-year time frame. So it has been a big adjustment for people. But don't expect that the level of prices is going to go down. It's just the level of prices is going to be increasing at a slower rate.
Great response. Got another question from the audience. What are the major geopolitical, international and domestic factors influencing the RBA's decisions about the Australian cash rate that we or our clients may not be aware of?
I mean, the Reserve Bank does look at everything, and it has to. But at the end of the day, their mandate is two things: full employment and price stability. Full employment means keeping the unemployment rate as low as it can be without generating inflation, and price stability means low and stable inflation that you can count on. So inflation between 2 to 3% over the course of the business cycle. When the RBA tries to think about geopolitics, it's trying to figure out how much tariffs can actually add to Australian inflation and how that will change their forecast for things. So it's sort of like, I think I just have to say, well, they look at everything, but the price data and the GDP and the employment data is of the most significance to them. But they have GDP, they have activity models, they have inflation models, just like we do as well. Like we have to, at any sort of presentation, people might ask, what do you think about gold? What do you think about commodity prices here? Anything, sort of have to be across everything because everything is an input into your model.
Makes sense. We've got one more from the audience. Great presentation, Diana. Now that cash rates are in decline, do you see APRA is going to reconsider the buffer from 3 to 2.5%, or is this an industry?
Yeah, I get asked this a lot, and I don't know the answer to that. It does make sense. I think it does make sense for APRA to relook at this issue. I mean, the reason that APRA has been cautious around lending was that in 2017 we had all those changes to investor lending rates, to lending rates, but to target investor lending, and in particular some of the interest-only lending that was being done. So APRA was quite cautious about that. And I think it does make sense to revisit the serviceability buffer, but are they going to do it? I have no insight, sadly, into these decisions.
Yeah, I appreciate that. Thank you. Sure you would all agree that what a fantastic update from Diana. So thank you very much.
Thanks, Joe.
Melissa, I've got a question for yourself. Another lender recently launched their own system and has made a bit of noise in the social media over the last week. What's different between the AMP new digital platform versus with what was launched with another lender in the last week or so?
Yeah. So what the other lender launched was the new version of Sympology's loan app lodgement platform. So that's a new look and feel, and I believe there were, some changes to what the existing version 1 platform looked like. What we are launching is a highly customised version of that platform. where we will be, as I said, verifying income and expenses and running rules up front. So it's actually been customised for us, so it is a unique proposition to us, but we will be giving you that visibility, I guess, of how we verify income and what we verify as expenses, both PAYG income, rental income and self-employed income up front. That will all be unique to our platform.
Just onto that, Melissa, if I could, the brokers have been involved in this platform build. Like, this is not something where we've just had token involvement. We've had brokers involved from day one, once we had the concept up and running. There was a phrase that one of them used, you might recall, that this experience feels like they've got someone with them. Do you remember that?
Correct. Credit analyst in their pocket.
Yeah. So I think that's the real magic here, right? Is it's not just we've reimagined what a platform could look like. We've actually changed the experience.
We definitely have.
Yeah.
And Paul's right. We have been meeting with brokers every fortnight to get their input, their guidance, their feedback on everything we're building. And obviously that inputs into the next iteration of the platform as we continue to iterate and build. But yes, because we're advising you what we're doing and what is verified, or, if something looks wrong in your expenses, for instance, as you go, yes, it is like there is a credit analyst sort of giving you hints and tips as you go.
There's another question that came through, Melissa, that we've decided to go with loan app Simpology versus apply online. Maybe you could give the audience a bit of an update as to the reasons why we decided to go down that path.
Yep. So we've decided to go with Loan App because we can differentiate that experience for you. So that means all of these things we're talking about how we're running rules up front and verifying things up front, consuming ID that you've done up front, is not something we could do through NextGen. So Loan App has allowed us to be able to customise and be flexible in how we do these things. So the version 2 is a great update. It's very user-friendly, but what we've done is, I guess, a whole lot of added functionality that we couldn't provide you today.
Great response. Just in closing, I just first of all like to thank the panellists today. First of all, thanks very much, Paul Herbert, Melissa Christy, Diana Mousina and Dave Askew for being on the panel today. Really appreciate that. For all the brokers for taking time out of your business, and also, again, to those that are affected by the cyclone and the cleanup, we wish you all the very best and a speedy return back to normal. If you're looking for CPD points, which most of you would like to align to today's session, we've got the MFAA and the FBAA. The CPD points are there on the screen for you, so please click on the QR code and register for that. I'd also just thank everybody for taking time out of their business today and attending the webinar. We look forward to holding and hosting another session for you in Q3. And thank you very much for attending the session.